Hello, everyone. This is Alexander Horat, your host of the Free American Press. Today, we're having a very special guest on the show, and his name is Joe Brown. He is the leader of Heresy Financial, and we're really thankful to have him on the show.
Yeah, well, thank you for having me on today.
Yeah, well, I wanted to ask you a little bit about the petrodollar and everything that's happening with Saudi Arabia. They're considering accepting the yuan for Chinese oil sales, so this is a pretty big step in basically weakening the U.S. dollar. So I just wanted to get your thought on this really big breaking news.
Yeah, absolutely. So this is by itself in isolation, and then if nothing else happens from this is itself not a very big deal. That it's talks. It's a little bit of oil. It's not all the oil between them. However, this is like, a mustard seed grows into a giant bush. This is small. Do not, as the Proverbs, do not underestimate the day of small beginnings. And so little things grow into big things. And this looks to me like the testing of the waters, just dipping your toes in to see what it's like, trying to just lay out a little bit of initial infrastructure and momentum, because everybody in the world right now, whether you're for the sanctions against Russia or against the sanctions on Russia, everybody is looking and saying, I want to make sure that I'm not, I don't have any weakness that I could be subject to getting that treatment myself. And so it doesn't matter what country it is. They're all looking at this and saying, I don't want that weapon to be used against me. And so we're seeing some countries are forced into a little bit of de-dollarization, like Nigeria recently. Their companies have not been able to get a hold of US dollars to pay taxes. And so the government has had to just say, all right, well, then you can pay your taxes in the equal amount of Naira on the day that the taxes are due, given the exchange rate on that day. So we're seeing little bits and pieces of global de-dollarization, whether it's by choice or whether it's just countries forced into it. And this one looks like, hey, we gotta start building out. We got to start building this relationship, testing the waters, getting a little bit of momentum going in this direction, because the day may come where we have to go all in on this, and we want to make sure that we've done it first. We want to make sure that we know how to do it. It's all set. The plan is there. The infrastructure is laid. The piping is ready to start to be used if and when we ever need it. So that's why I think this is a big deal, not necessarily because in and of itself it's significant, but because of what it means for the future. And really, the dollar has value globally because everybody uses it for international trade. Oil is priced in dollars around the world. And so the more and more and more we see moves away from that, the less need anybody on earth has to get their hands on dollars. Like you and I as American citizens, the US dollar, its intrinsic value comes into play that when we have a job and when we have business activities, if we don't collect enough US dollars throughout the year to hand some of them back to the government, we go to jail. So the incentive for us, the intrinsic value in the dollar for American citizens is to stay out of jail, to pay your taxes.
Right.
Well, around the world, the intrinsic value in the dollar is collect enough of them so that you can do international trade, buy things from other countries, buy oil, things like that. When that piece starts to go away, the world has less and less and less of an incentive to hold on to dollars or to go after and get dollars. You have more of an incentive to dump dollars, and then that can spiral out of control where the value of the dollar crashes versus everything else, and all those dollars come back home.
Yeah, I definitely think what you're saying is true. And one thing I wanted to ask you too is we're seeing, Saudi Arabia, if they do this, they're going to be breaking, decades of, tradition in using US dollars for its oil. And we saw in the past how the United States has reacted to countries like Libya when they try to get on the gold standard and get rid of the US dollar. So what is kind of your thoughts on the US reaction if the Saudis do decide to do something like this? Do you think they may start a war, or do you think there'd be some really big reaction? What do you think would happen?
My guess would be no reaction at all, given everything else that's going on right now, and given the benign nature of how this looks initially. I wouldn't expect any sort of reaction initially. Now, maybe if things change, and maybe if, overnight it's, all oil or something like that, then maybe there'd be a different story. But just with everything going on right now, I'd be surprised to see really any reaction to it at all from the US.
Yeah. So I'm gonna share the screen to just show the current oil prices. So I just kind of wanted to get your take. So we saw, oil went really, expensive per barrel, over $100, and it actually has gone down by quite a big percentage in recent days. So what are your thoughts on like the oil market, say in the next few months or next month? Do you think it's going to continue to go up, or do you think we're going to start seeing a price correction where it's starting to go down, like it's starting to right now?
Yeah. Yeah. For a market like oil, I tend to stay away from the short term forecasts and more on the long term, because that's just where I feel more comfortable. Short term, it's possible that most of the selling has already happened now. I've been saying for a year and a half now that we're in a structural bull market on oil. We've just got a global setup for the oil price to go much higher for a long time, for years, 5 to 10 years type of thing. And that's mainly due to the underinvestment in the industry, the low reserves for the last decade or so, off of the backs of wasted money, but prior to that, when oil prices were really high. And so on the backs of that, I've been anticipating oil to go up for a while now and far into the future. We've had a massive run up recently from Russia invading Ukraine. And so that's possible. It's possible that we still see some selling as a result of a correction from that. But ultimately, my long-term view on oil is still up for the next 5-10 years.
Yeah. So is your projections for most commodities up? Like, for example, what are your thoughts on commodity like copper?
Yeah. Yeah, definitely. Across the board, on average, commodities up and higher. When you get into inflationary environments like this, the stuff that you need to make the stuff, so commodities and energy and food, land, agriculture, all of that just does very well, because those are the building blocks. That's the foundation. So it's a rising tide lifts all boats, basically. Now there are certain commodities that have experienced a lot more of the price rise than others. You can look at something like copper has done much better than something like gold or silver. And so going into the future, 6 months, year, 2 years, you might see differences in performance depending on the commodity that you're looking at. But broadly, I would anticipate everything on average up and up and up for the next coming years.
Yeah, that definitely makes sense, especially if the inflation rate increases. And we're seeing some big things happening with the Federal Reserve. And I really like your mug that you have, and the Fed. I think that's a really good thing. But we're seeing that markets expect 25 basis point Fed rate hike in March. So I guess that's happening in a few days. So I just wanted to get your thoughts on that. And basically, how do you think this will affect the markets if they do decide to do a rate hike?
Yeah, absolutely. So really, this is like a good visual of what's going on here. Do you ever see those infomercials where they're it's for something like a flex tape or something like that, where they've got a big vat of water and there's a big hole in it, and then they slap some sticky like a patch on the side, and it plugs the hole like right away. So inflation is like the water running out of the leak, running out of the hole. And instead of slapping a big seal on it, which would be jacking up interest rates and selling assets off their balance sheet really quickly, what they're doing here is like, they're putting one little finger in the stream of water. So a 25 basis point, which is 0.25% rise in interest rates, won't do anything to inflation. One of the reasons for that is because monetary policy takes about a year to work its way from start to finish to get through to the prices of goods and services. This is the Cantillon effect. You see it hit asset prices first. And so if as we see the Federal Reserve start to do things like raising rates 0.25% at a time, we'll see some volatility in the markets. We'll see some sell-offs. We'll see some downward. We'll see some, bearish pressure on real estate. Whether or not that translates into a downward actual price in real estate is debated, and I think it won't. But essentially, you see that bearish pressure on asset prices first before that ever makes its way over into goods and services. So we're entering into this phase right now where we're probably going to still have a high rate of inflation of the stuff that people need to live at the same time as we're having stock market go down. People's wealth is coming down right at the same time as people's costs are going up. And so really bad mix here. And the only caveat to that I would say, if we do see a reduction in the rate of inflation, let's say it goes down to 6%, 5%, 4% through the rest of this year, it's not going to be from the monetary policy that they're doing right now. Raising rates doesn't impact goods and services that quickly. It just can't. The Federal Reserve has said this before. They've talked about the lag time between what they do and when it hits the economy. If we do see a reduction in the rate of inflation, it's going to be because of 2021, the massive drop in the growth rate of the money supply. 2020 saw a 25-30% growth rate in the supply of money. 2021 ground to a halt. Political gridlock. Spending was way less than what people thought it was going to be during the entire year. And so a lot of the inflation that we saw, especially like during 2021, was a result of what happened the prior year. And so if we do see a slowdown in inflation this year, it's going to be because of the slowdown in spending that we saw during 2021, not because of the 25 basis point increase in rates, which is ultimately even a worse sign for markets and the economy, because essentially what they're doing then is they're throwing in these deflationary moves, little tiny ones, but raising rates 0.25% at a time. They're basically pulling the rug out from under the economy right as it's slowing down, right as asset prices are starting to fall, right as we're starting to feel the impact of the decline in the growth rate of the money supply, and then the rising of interest rates is all going to hit at once, probably towards the end of this year. It's like a rug pull out from underneath an already slowing economy as prices are still going up. So we've got a whole mixed bag of dangerous chemicals that are very volatile and could lead to a big economic explosion right now.
Yeah, so do you think this will adversely affect the real estate market in a big way, or since it's such a little rate hike, it might not? Or what are your thoughts on that?
Yeah, that's a great question. So number one, it depends on the area. Depends on the area that you live in, because averages hide extremes. And so our body temperature, let's say, it's supposed to be right around 100 degrees. And so if we say our body is at 100 degrees on average, we think that's great until we realize that our toes are 50 and our head is 150. We're actually dead. So averages hide dangerous extremes. So when you look at certain cities, certain places, you're going to be able to very clearly see that's negatively affected. The real estate prices there are going to start to crash. Like if you look at real estate over the last couple of decades, on average in the United States has done extremely well. But if you look at places like Detroit, you wouldn't have wanted to invest there. So the averages hide the extremes. And so on average, I do expect that housing prices will continue to go up. We've got the supply and demand dynamics are set for years to come. We've had years of severe underbuilding compared to demographics for 5 to 8 years following the financial crisis. And so while we do have a high rate of building right now, number one, the completion rate is slowing because of supply chain issues. And number two, they're just catching up to what they missed out on for almost 10 years. And so we've got basically an entire generation, a lot of millennials who are sitting on the sidelines, living with parents and renting, because they're looking at this and they're saying, this is exactly what I lived through when I was in college or high school. I don't want to buy now. This is the worst time to buy in history. And they're all sitting on the sidelines, and none of them have bought yet because either they can't afford it or they can afford it and they're just scared to pull the trigger. And so we've got a massive demographic here that's just not It's not like it was 12 years ago where people were buying 2 and 3 and 4 houses and thinking they were getting wealthy on it and it was a bubble. There's a very big difference between a bubble and prices being high. There are very, very, very few similarities between what's going on right now and 12, 13 years ago. Right now, like 95% of people surveyed about real estate say that it's the worst time to buy in their entire lives. That's not what you see at the top. That's what you see at the bottom or before you've got a top in the making in a couple of years from now. So we've got all of these dynamics at play that look like prices are going to continue to go up. And so if we get interest rates starting to go up even a lot faster, typically, all else being equal, let's say housing prices are stable. If you have interest rates rising, then that would push prices down. And so you've got, let's say interest rates go up by 1%, prices would go down by 10%. But right now, we don't have housing prices staying stable. We've got all these other forces pushing housing prices up. And so if we have interest rates start to skyrocket, those will be negative pressures on real estate. But are they going to be enough to counteract everything that's pushing real estate up? Most likely not. And at worst, if we get like a 3-4% rise in interest rates, then you might have a 5, 10, maybe 15 or 20% drop in real estate prices on average. That's nothing compared to the equity. And so that's not even enough to impact people's ability to pay their mortgages, people's, people are starting to foreclose or being underwater. And so with everything going on right now, I don't expect any sort of a real estate crisis, housing bubble popping or crashing, anything like that, especially as a result of these tiny little interest rate hikes.
Yeah, so real estate will probably continue to keep going up like you were saying then. Okay.
Yeah, that's what I expect.
So you've been hinting on your channel that you think there may be a recession coming. Do you think we're starting to enter into a recession? And how long do you think, a recession will last this time compared to the 2008 one? And what are some big signs that you think will happen when we're really entering that recession really in a big way?
Yeah, so there's I want to define what I'm talking about here because people throw around a lot of words and conflate them. There's a big difference between a recession and a crash and like a depression. So a recession is 2 consecutive quarters of a decline in GDP. So you can have a recession with the stock market going up. You can have the stock market crash without having a recession. I think there's a almost, not 100% chance, but it's very, very close. In my book, it would probably be over 90% chance that we see a recession start before the end of this year. Now, I don't necessarily think that's going to translate to a crash in the stock market. Many stocks have already seen a bear market. They're already in bear market territory. They're already down 20% from their highs. Many tech stocks are down 50, 60, 70% from their highs. So we've already seen in many areas of overvalued assets, the sell-off has happened. And so I don't anticipate that if, let's say next quarter, it's like, okay, well, this is our first quarter of a decline in real GDP. I wouldn't expect that would translate to, a 30, 40% drop in the stock market. It just doesn't work that way. We could even see much higher highs in stocks while we are seeing a recession last for, 2, 3 quarters. And so I do expect that we enter into a recession soon. But when I say that, I'm being very specific with my definition of 2 consecutive quarters of a decline in GDP. And I don't anticipate that we have a giant economic collapse, stock market crash, things like that until later. Like I think the recession will probably show up first.
Okay, so it's going to be kind of a mini recession, and then we're going to get into a big depression. Is kind of your thought.
And yeah, well, yeah. So my confidence level on a recession happening soon, a technical recession happening soon, is very, very high. After that, I would anticipate, in the next year, in like a year from now, something like that, that we see a major collapse start to happen as a result of what the Federal Reserve is doing right now and the monetary supply is going through right now. And then in the rescue plan of that, I would anticipate that then we start to risk hyperinflation. We start to see the prices of everything start to not go up by 8% a year, but 10% a month type of thing, like really high. But that's further down the road. That's not right now.
Yeah, that's definitely pretty scary. That's pretty much what has happened in Venezuela and is really happening now. Uh, so yeah, pretty much the way people can prepare is, getting on commodities like you're saying. You thought, commodities in the long run are going to go up. So I think that's pretty spot on. Would you like to tell the viewers a little bit about your channel?
Sure thing. Yeah. So heresy financial, for anybody who's not aware, the word heresy is it's an old religious term. It means somebody, it's an opinion that is profoundly at odds with what is generally accepted. And so I use the example of Galileo. He was considered a heretic by the church because he said, hey, the earth goes around the sun, not the other way around. And turns out that he was true. And so what is considered heresy is usually or sometimes found out to be true later on. And so I just talk about things that are happening in the economy, in investing, anything related to those areas. And then I've got the Twitter channel there, Twitter account there as well, where I talk about very similar things.
Yeah, that's really great that you're trying, to educate people on all these topics so they can survive, in the future and, get better financially. So that's really great that you're doing that. Is there anything else you'd like to add in this video? Anything else you'd like to say about, everything we've talked about?
No, thank you so much for having me on, and keep on doing stuff like this. And for everybody, keep on studying and increasing your financial literacy, because we're entering into a period of time where it's not going to be like it was for 30, 40 years, where it's just kind of like work hard, save, invest in your 401k, and you'll retire rich. It's we're entering into a very volatile time where you have to pay attention to what is money, what is a real investment versus speculative assets. So get financially literate and pay attention, and we might have some rocky roads ahead, but the more prepared you are and the more educated you are, the better you'll be able to weather that storm and take care of those around you.
Yeah, you're definitely right because we saw in Russia just recently, people who had their money with the ruble and everything saw 30% of their wealth just go away in a day. So you're definitely right about that. And I would just really like to say thank you to Joe for coming on the show, and I really hope we can have you on the show again soon.
Sure thing. Thank you so much for having me.
Yeah, and thank you all to the viewers who are watching. I hope you all have a good day. God bless.